What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are breaking down two advanced trading options for you to learn about, to dive into, and to see how they work. So if you're excited for today's video, as always, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. Now, in today's video, we are covering two options trading strategies that are advanced level. So you do have to be approved for this level of options trading. It's not just anybody can do it. I believe on Robinhood, these are level 3. So make sure you look at your brokerage account and make sure you are approved to trade these kind of options that I'm about to break down. Now, these two trading strategies here both have obviously risk, just like any other options trades you have. There's some similarities and a little bit of a difference between the two options here. And we'll break it down. We'll talk about how to manage it potentially and where we could go from there. The first one we're looking at is what is called an Iron Condor. Now, this Iron Condor, as you'll see, the name comes in. If you go back actually to the option, it says, hey, look, it's an Iron Condor. It's really cool. So we have this Iron Condor here, and basically the idea behind it, it's a advanced option trading strategy because you are basically opening up 4 contracts on SPY at the same time. Full disclosure, when you are trading an Iron Condor or any of these advanced strategies, when you have multiple legs, make sure you're looking at stocks that have a pretty good amount of liquidity involved in the options chains, because you don't want to get filled too low. You don't want to get filled too high. You don't want to lose out on those dollars when you're buying it. You have to buy higher. When you're selling it, you got to sell lower. You want to make sure you definitely do have a lot of liquidity. SPY, QQQ, NVIDIA, Tesla, like all those major name stocks have a lot of options and a lot of liquidity. So you'll be able to enter those trades pretty much in and out as you need to. So keep that in mind when you're doing these. It doesn't work just for any stock in this case. A lot of the smaller trading ones that don't have a lot of options probably won't work well with, because you might have to get filled at different prices and you might lose value because of that and everything else. So basically how the Iron Condor works. And basically what I did is I broke down the trade as to what it looks like here. And again, I use options strat here to give you the visual. I use options profit calculator to track my calculations. But what you'll see here is this is SPY. And basically the Iron Condor focuses on selling 2 options and then buying 2 options at the same time. So you have 2 selling and 2 buying. And you're going to sit there and say, well, Fridge, I'm thinking that SPY is going to be range bound for the next 10, 20, 30 days maybe. And maybe because the volatility has died down, because, you know, news talks of trades have been kind of stagnant in a way. No breaking news came in. I know NVIDIA had great earnings, which had a little bit of a, pump to the market recently, but now they're back down a little bit. So you're sitting there saying, Fridge, I'm thinking that SPY is going to basically just trade sideways. This is what an Iron Condor example might possibly look like here. So basically what you are going to do is you're going to sell a put option, as you'll see here. You're going to sell a put option, which in this case I did 573, and then you're going to sell a 606 call option. So basically you're betting that it's going to stay between $573 and $606 between now and the date of expiration, which is 22 days for me, which is looking at June 20th. So SPY is going to trade basically between those 2 strike prices here and here. Now, the problem that we always face with selling options is you have to have collateral. I do videos on cash secured puts. You need to have the cash available to buy the shares. You can also do covered calls, and covered calls, you need to have the 100 shares as collateral as well. Now, the problem is sometimes you don't have, this is basically, if you're just selling these 2 options here, you're looking at over $100,000 worth of basically of this, because this would cost you over 50 G's to buy the shares. This would cost you over $60,000 to have the 100 shares to offset. So you don't have that much capital. What do you do? Well, what you do is, instead of having the collateral in the cash or the shares, is you can buy a contract that represents 100 shares at 572, basically below the strike price of what you sold it at. So I'm selling at 573. I'm going to buy the 572 as a collateral for the put side and also for the call side. These 2 bought options here count as the collateral in case either of these go sideways. And what you want to hope for is that as long as SPY trades between 572 and 606, we collect $42 out of $100 in capital that we're trading this with. Max loss is 58, max profit 42. You're looking at almost a 50-50 return here. You're looking at basically literally a 42% return on this trade in itself in the next 22 days, as long as SPY trades between these two levels. If you want to see how to open one up on Robinhood, for example, here, you can go to view all options. I'm not going to go to mine. I'll go to a different one. So say you want to go June 30th. And the market just closed. It's 4:04 now. The time I'm recording this, the market just closed. You can't actually trade this. But say you wanted to say, Fridge, I bet that SPY won't go above 610. And then you're like, but you know what? What if it comes down? Okay, well, maybe I don't want to go below 570. So what you'll see here is it kind of creates this idea, but your max loss is unlimited because as it goes further and further and further, again, your max loss would be the 100 shares times what you pay for at 570. So it's $56,000 here. And on the upside, same thing, unlimited loss up here as well. So there's a lot more loss that you'll see here, which we don't have the capital in case this goes sideways, and I don't know what to do. So you're saying, well, Fridge, I think I'm pretty confident it's going to be between 560 or 570 in this case. And, the other one is 610. But just in case, to have some leverage and to have some, collateral to put up in case, and I don't have the shares or the, cash to buy the shares, is all you're going to do is you're going to buy. You can buy the 1 strike lower, you can buy the 2 strike lower for collateral, you can buy the 3, so on and so forth. I usually stick with just a $100 difference here, only because it's easy for me to trade with right now. So I'm looking at buying, a $1 difference. So that's going to offset, these two are going to offset. Basically what you're looking at is 2 credit spreads. You're basically looking at doing a call credit spread and a put credit spread. And basically those two come together and they create what's called the Iron Condor. So basically a put credit spread, I'm going to bet it won't go to 570. I don't have the cash to buy it. So I'm going to buy this option here to count as my collateral. And the difference in strike prices here is what you will get for this side of the trade. You do the same thing on the call side, very, very similar. I'm going to go up to here. I'm going to say, okay, well, I don't have the 100 shares to give, and if this goes to the 610. So let me just buy the call option to offset that as well. And what you will see here, what did it do? Oh, I sold this one by accident. Oops. I was like, what am I doing here? You got to buy it. There we go. And you'll see it buys it here. I was like, do not comment in the section. I already know. Okay. It's been a long day of teaching. We're at the end of the year. I'm losing my brain sometimes here. But you're going to buy the option above it. So sell the option above it. And what you'll notice here is that it creates the Iron Condor right here. And basically saying, again, as long as it trades between these two, you're good. And look at the returns. $39 and the max loss is $61. Because again, you're trading in a $100 difference because the strike price is $1 here. So you're looking at basically $100 here. Max profit 39, max loss is 61 or 40 in this case now. And it's pretty good odds. I mean, SPY goes up, it goes down, usually goes up more than it goes down. But, for the short term, for the next month or so, maybe we could trade sideways. You can collect that nice cash and call it a day. Now, with managing it here, as you get closer to one side, if you get a little bit nervous, you can always just close the entire position out. You can just go in, you can say close, it'll close the entire position, no problem, and you can close it out and call it a day. The other strategy that I'm experimenting with is what's called a double calendar spread. This at first can be very, very confusing, all right? Basically what you're looking at, and I'll do it with SPY again, and I'll show you what my position is, and we can kind of break it down from there and then call it a video after that, is that when you're looking at SPY, so say we are going to go 32 days out, for example, and you want to sell an option for SPY at, say it's not going to go to, again, 610. Okay. Oh, cool. I get that. I get a nice little payment up front, $257. Love it. Max loss unlimited because, again, I don't have the cash for it and it can always go higher. But there's a lot of loss at stake because this is basically what's called selling a naked option. Naked option basically just means you don't have the cash for the put side. You don't have the shares for the call side. So it's like, you're just kind of running wild here, literally like you're running butt naked almost. It's crazy, right? So it's a naked option here you're looking at. But let's say, well, Fridge, I want to, sell this in the short term, but I'm long-term bullish on SPY. I'm long-term bullish. I'm looking at, maybe I want to go until the end of the year. I'm going to buy an option. I want to go long-term. I'm going to buy, a 612 or something like that. Okay. Now, basically what you will see here is it creates this nice little calendar spread, because what's going to basically happen is that you pay for this contract, which is going to take a long time to expire. So this contract doesn't lose as much value because there's so much time on your side. You have, 7 months for this contract to expire, hopefully at what you're looking at for break even. So there's not as much value being lost. There's not as much decay happening because there's so much time on your side. But the short-term one only has a month to not hit 610. So basically, this contract right here is going to expire in the next 30 days. This one's going to expire in the next, 7 months. And if SPY doesn't close above 610, you collect this here. This option might lose a little bit of value, but it's not going to lose nearly as much as what this option will lose. So you'll collect whatever the difference is. It's called a calendar spread. Okay, you might hear is what's called a poor man's covered call. Is another way of looking at it. Very, very similar ideas to it. Basically, again, so as the share price goes up, cool. Your max profit is here at $610 because again, you're making that nice little premium there. But then you still have some profit to be made here until it gets down to 640 because this option becomes worth more money, as you will know. So that's what's called a calendar spread. Basically, a poor man's covered call. There's different words for all these different strategies here. Selling a short-term option for premium, buying a long-term option so that decay from the long option doesn't offset the short-term that you get from the sold option. And again, if you have to exercise, you do have the 100 shares in this bought position here as collateral instead. So you still have it. So now the question comes in and says, okay, Fridge, well, what is a double calendar spread? Basically, a double calendar spread, which is something I'm still trying to fool around with, is you're doing the same thing, but instead of doing it for just call side or just put side, you're doing it for both. And this is what the chart looks like. Take a look at this. It looks really interesting to see what's going on right now. And this is what's called a double calendar spread. And what you will notice is that we're looking at this one should have been at the exact same. Sorry, I was at the wrong strike price. It's 610, not 612. Same strike price, longer term bought option, shorter term sold option, calendar spread. Sorry, I was thinking of the diagonal, actually, which is a whole different trading thing in and of itself. Anywho, so we have a double calendar here because what you'll notice here is I did the same thing for the put side and also for the call side. I'm looking at June 13th sold option here. So quickly take a look there. The 576 sold option, so don't go below 576, but then the bought option, but it's a week out. So 613, 620. So they offset the dates. Short leg, long leg. Sitting on the call side, short leg, long leg. And it creates this kind of nice, cool looking like 10th, picture here. And what you'll notice is that, as time is going to go on here, what will happen is the short legs, these two down here, are going to decay and lose a lot of value. These long options are still going to lose value, but the goal is to have it where the long options don't lose as much value as the short options. So that way you can collect the difference. If these two are decaying faster than these two, you will collect the difference between the decaying factor. So if this contract is down $100, this one's down $50, I collect $50, for example. Because this one lost 50, but this lost 100, I'm still up $50 because again, these were sold options. Now, it goes in either direction, right? So as this one starts to decay, it becomes more money. As this one decays, it gets more money. And it also kind of pushes out your break evens a little bit more. So instead of my break even at 603 and 576, it's actually at 567 and 610. So the break evens are a little bit more farther out for me to loop to, break even and not lose money. There's a little bit of a dip here. Basically, it's saying if SPY just trades literally sideways for the entire 22 days or 15 days, I will lose, max like $20 if it trades completely range bound here. Now, the question that really remains is how do you manage this? Okay. And when is it good? A double calendar option play to me, and I can show you what mine looks like here. So let me go back to my position here. This is my double option in case you weren't wondering what it was. So again, sold the 603 at 613 June 13th, bought the 603 June 20th, sold the 576 the 13th, and bought it for the 20th, right? So that's my 4-leg option play here. And right now it is up like $10, which is great. The decay is starting to happen. Every day that goes by, there's no crazy move in the market, just like the Iron Condor, right? The Iron Condor here isn't going to it's not going to change much. It's going to decay and lose value as SPY trades sideways. It's the same thing here because those options become worth less. But you want to have a little bit of movement and have what's called implied volatility expansion at some point. So a good way to trade this one potentially would be probably on one. What's a company that's going to be a big one coming up? I'm trying to think off the top of my head. I wonder if I can go to like Tesla, like way far out. I want to see when Tesla's earnings are, and I'll give you an example here. The Tesla price. All right, let's take a look here. When it would be their next? I don't know if they're going to have their earnings already announced or not. July 22nd. Perfect. Okay, let's go to July 22nd, around there. So let's go to trade options here. Let's go to sell July 22nd. The closest one they have is July 18th. So what you'll notice here is that these options have an implied volatility of 63%. That's before earnings. Earnings are 22nd. This is before earnings, so it's 63. I don't know if this one is going to be a little bit higher or not. That's a little bit higher. What will probably happen and what you'll notice when the option chain comes out for after July 18th, so the July 25th, the July 18th options here are going to have less implied volatility than the 25th ones because one's before earnings and one is after their earnings. And so the focus behind this strategy here is to let the before earnings sold options expire worthless. And what's going to happen is as you get closer to earnings, the volatility picks up for those bought options there. So they tend to lose a lot less value because there's so much volatility built into it. And my advice would be before any kind of big earnings report, close the entire position so you don't get hit with those crazy declines and your options go crazy, right? So my idea is to open up these trades here, one for before earnings for a big stock, one for after earnings on a big stock, and then hope to close before earnings come out, collect that maximum premium, and then close off the bought options for a smaller loss because there's a lot more volatility built in. The trade that I did here with SPY, as I was experimenting with it, the 2 days, if you're ever wondering, saying, why did you do the 13th and the 20th? And if you're not sure, I wonder if you could figure it out. Put it in the comment section if you made this far and you know this. The reason why I did the 13th and the 20th is because FOMC meeting is between these 2 days here. I don't know what the exact, I think it's the 18th, I want to say. But so my guess is that when FOMC usually comes out, there's a lot of volatility baked in. People start to freak out. Does Jerome Powell say some craziness or what? He says something about interest rates, something about inflation. Market drops 2% potentially. Who knows? You might get those big moves. So what I did was I sold the options for the week prior to FOMC and I bought the ones for the week after. So that way, hopefully these sold ones lose their value. They expire worthless. The bought ones I will close for a small loss and I will collect the difference. So that is called a double calendar spread. Something you have to be able to manage and see what happens. As you see a huge move on one side, as long as you don't get a huge move in SPY, 2.5%, 3%, whatever, in the next, 20 days, 15 days, so about 2 weeks out, as long as you don't get that huge move to either side, this is going to start to, the decaying is going to happen with the sold options. And what I also did was with the Iron Condor basically saying, don't move. So if this one doesn't move, this one's a small loss, but this is still a gain, and vice versa. So they kind of somewhat play off of each other a little bit with the double calendar and the Iron Condor. So I know it's a longer video, and I hope you made it this far and you're not bored of my annoying voice yet, hopefully, and you love Fridge Financials. But again, just to give you the visual recap, Iron Condor basically means you're collecting premium, but you're hoping that SPY trades within a certain range. The smaller the range, the more the premium is. The bigger the range, the less the premium is. So it's all about how much due diligence and research you do for an Iron Condor. for a double calendar, again, you're basically hoping for that the volatility expansion to happen before a huge event or huge news, earnings, FOMC meetings, interest rate decisions, you name it, whatever. And you collect the premium before that event happens. So when it does happen, you've already closed your bought options for probably a small loss, but you've had a bigger return in the sold options because those lost value faster. So double calendar, Iron Condor, both some very advanced positions here and some advanced trading strategies here that we're looking at here. But hopefully learn something new. I will always bring back some more. I've learned some new positions and some new strategies as of recently, so I'm making some more videos about that as well. Thank you guys, as always, so much for watching today's video. If you made it through this very long video, as always, feel free to like the video, subscribe to the channel, and always turn on those bell notifications as per usual. I hope you guys make money in the market some way, shape, or form. Maybe it's through these. Maybe just buying and holding. Up to you. Whatever you want to do. Hope you make money in the market. And as always, I will see you guys in the next video.